we've been tracking this Beijing to US gold war since 2010, and it's significantly picked up since then. Now, this is gaining traction, big time. Gained traction after Russian assets were seized into an openly weaponized US dollar and in the sanctions that relate to that. And the official dedollarization gauntlet Beijing literally threw down directly after Trump tariffs were threatened. So they literally openly said, right, okay, you want a fight, we'll have a fight. We've got the gold.
The global financial order is entering one of its most consequential transformations in decades. Behind the noise of daily market moves, an intense and deliberate power struggle has been unfolding between East and West, centered not only on trade and technology, but on control of the world's monetary foundation. Beijing, Moscow, and New Delhi have been quietly but steadily building their arsenals, not of weapons, but of gold. Since the early 2010s, China has amassed vast, unreported quantities of physical bullion, positioning itself for a moment when the dollar-based system weakens beyond repair. That moment, many believe, is now approaching. In recent years, the geopolitical chessboard has changed dramatically. When Western nations seized Russian reserves in 2022, the message to non-Western economies was clear. Dollar assets are no longer politically neutral. Almost immediately, China and its BRICS partners began intensifying efforts to insulate themselves from the weaponized dollar. A new gold-centered monetary framework began to take shape, first through bilateral trade settlements in yuan, and then through gold-backed financial instruments that bypass the Western banking system altogether. Each of these developments has placed immense upward pressure on gold, and by correlation, on silver, the smaller, more volatile metal that historically outpaces gold in every major bull market. China's strategy has been precise and patient. For over a decade, it has drawn physical supply from the West's paper-based markets, building enormous reserves under the radar. Now, with the Shanghai Gold Exchange and its international counterpart facilitating true physical price discovery, Beijing is poised to challenge Western dominance in global bullion pricing. A sustained realignment toward physical settlement and Asian-led pricing mechanisms could permanently undermine the COMEX and the LBMA's ability to dictate gold's valuation. And as this process accelerates, the dollar's purchasing power, already eroded by decades of monetary expansion, faces unprecedented pressure. For the United States, this represents a critical inflection point. Popular British whistleblower Andrew Maguire and other leading analysts argue that the only viable path forward for Washington, particularly under the Trump administration's renewed economic nationalism, will be to officially revalue America's gold reserves. By backing a portion of the dollar with gold, the U.S. could restore credibility to its currency and contain the fallout from relentless debt accumulation and Federal Reserve-induced inflation. Such a move would be seismic for gold and potentially explosive for silver. In today's video, Maguire connects the dots between the weaponization of energy markets, the Fed's mishandled gold positions, and a global pushback led by China and its BRICS allies. His analysis exposes how the U.S. Treasury's covert interventions have only delayed the inevitable revaluation of gold, and how that very revaluation could soon become America's only lifeline. Stay tuned, because what he's about to reveal could reshape everything investors think they know about gold, silver, and the future of the dollar. Don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss these deep dive analyses.
It's all connected. In combination with very fresh weaponized geopolitical energy sanctions, that's primarily to put pressure on the core Russia-India BRICS fulcrum, the RICS portion of the BRICS fulcrum. Trump was also attempting to push back against the gold-rich BRICS alliance. Now, what is visible is, alongside the weaponizing of energy geopolitical sanctions, billions of dollars of COMEX gold and silver were created and sold into the market to cap the gold price from breaking above 4,400. Risking, because really 4,400, I mean, that was risking forcing the Fed to buy back upcoming end of month borrowed Bank of International Settlements gold bets at over $600 higher than last month's 4 tons being squared $409 at a loss. Now, the Fed is the only central bank still fighting a rising gold price, and it's completely mishandled the US Treasury's gold positions. And with 30 tons still to be bought back, plus billions of dollars of the Office of the Comptroller bets, the OCC bets that are visible to anyone, these bets directly relate to US Treasury rehypothecations, double ownerships, and so really what it's potentially doing is facing a default into this incredible physically supported rally. Obviously, a portion of that was not the physical buyers. Now, US Treasury gold positions, so basically, still have to be 30 tons, still has to be bought back, plus the billions of OCC bets that already relate to these rehypothecations. So that's a real issue. Now, while any other trader would be margin called by their broker and forced to cash settle such enormous unhedged losses, it required, and this is why we know it's official, it required the US Treasury to step in to temporarily staunch the massive de-dollarization flows evident in the gold-dollar foreign exchange cross, i.e. selling dollars to buy gold in the FX crosses. Don't forget, it's a currency. And they would have, so what they did was could have easily weighed up the scope of such a pushback, but as temporary though, and directly limited, they would know it's directly limited to how many COMEX speculators could be rinsed out before physical support equilibrium could have been reached. And that equated to a 10% correction. Now, the media has been likening this price smash to struggling to find some sort of parity to what's happened in the past, even though things have changed so rapidly. So they would likened it to the 3 year. They were talking about the 3 years ago, the 2013. Oh, yeah, there was a $600 a sell-off from $1,600 to $1,000. Whereas in reality, the scope of this flush was 3 weeks. It's a 3-week gap close that's been limited simply to how many naked long speculators holding open interests could be sucked in before just simply pulling the plug on the strategically timed COMEX-centric margin borrowing cost increase, which by no coincidence came in double whammy as gold was rising. Now, this planted, it's form-fitting. This kind of form-fitting mainstream media analysis illustrates that the mainstream media's lack of understanding of how dislocated the legacy gold and silver unallocated, unbacked, leverage price setting COMEX exchange has become versus the SGE, the Asian, the physical supply demand based price setting mechanisms that have evolved, and that very short term spec-induced volatility aside, the COMEX is no longer in control of setting the global price of gold. Now, what's missed by the majority of the legacy market analysts is that these are the people that pen pieces on Financial Times, and actually many of the newbie, what we call the newbie tourist gold experts that appear on Bloomberg, etc. They're just not used to talking about gold. So they haven't made the connection between the Bank of International Settlements reclassifying gold as a first-tier net stable funding ratio compliant asset class on the 1st of January 2023, as can be evidenced by the dwindling open interest, really, into the subsequent $2,500 rally, legacy rally, that real money open interest has exited the COMEX, exposing old school COMEX-driven price setting games that just no longer fit for purpose. Gold's risen over $2,500 since that point. Now, this very sticky real money has only just commenced gaining exposure to high-quality liquid asset physical gold outside the paper-diluted LBMA CME ring fence. Now, what's not being secured and physically removed from underpriced paper-diluted local underfixes is being secured in the very liquid Chinese SGE influenced Western-facing SGEI, international-facing physical exchanges. Now we've been tracking this Beijing to US gold war since 2010, and it's significantly picked up since then. Now this is gaining traction, big time. Gained traction after Russian assets were seized into an openly weaponized US dollar, and in the sanctions that relate to that. And the official de-dollarization gauntlet Beijing literally threw down directly after Trump tariffs were threatened. So they literally openly said, right, okay, you want a fight, we'll have a fight. We've got the gold.
The intricate mechanisms Andrew Maguire describes are not isolated technicalities. They are the financial plumbing of a system under extreme strain. The creation and sale of billions of dollars worth of synthetic COMEX gold contracts to suppress prices reveal how desperate Western monetary authorities have become to project stability. Yet, the Federal Reserve's mismanagement of Treasury-linked gold positions, unhedged derivative losses, and the reliance on speculative liquidity have all converged to create a high-risk environment. Meanwhile, global gold demand, particularly from sovereign and institutional buyers, continues to surge. The physical market is pulling in one direction, while paper markets are stretched in another, and that divergence can no longer be sustained. Against this backdrop, the broader geopolitical context becomes decisive. China's gold and silver accumulation is no longer a side story. It is now the central pillar of its de-dollarization strategy. With gold now reclassified as a Tier 1 reserve asset under the BIS's Basel III framework, the monetary landscape has tilted in Beijing's favor. The yuan's convertibility into gold, through newly opened physical exchanges, has accelerated its adoption as a settlement currency. As the BRICS alliance expands its influence, Washington faces a narrowing set of options, and a gold revaluation, once unthinkable, is rapidly becoming the only realistic one. Maguire's upcoming segment delves into how this process may unfold and what it means for the balance of global financial power.
And here are just three of these most recent takes. I just say, call them take the gloves off mandates to attract global gold buying and storage. US-sanctioned Russian asset seizures and tariff wars are evidencing China de-dollarizing, and most definitely this has Trump's attention. China aims to become custodian of foreign sovereign gold reserves to strengthen its standing in the global bullion market. Driven by Beijing's opening up direct convertibility to the yuan to gold and gold to the yuan FX structure, initial investors, financiers, hedgers, etc. operate in a smoothed out, true, physically settled supply-demand price, and is a primary reason the dollar's share of global reserves on a balance sheet has surpassed US Treasuries. Now, this Financial Times assessment here illustrates that foreign central banks now hold more gold than the US Treasuries. However, given this official data fails to include thousands of tons of unreported monetary gold central bank buying, and with China alone securing a conservative 80,000 tons, and Russia, India, Saudi, and the BRICS another 30,000 tons, the percentage is far likely closer to 60% and rising. Now, in the meantime, Chinese and Indian gold and silver buying continues to compete with Western ETF demand. Gold is not rising. It's simply evidence that the dollar is being diluted with gold holding its purchasing power. It's that simple. So the de-dollarization process is a natural event. And circling back to who and what was likely behind the official gold pushback against an out-of-control China-orchestrated BRICS plus dollar to gold de-dollarization escalation, i.e. just swapping dollars for gold, of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, which would actually be enormously beneficial for the dollar, let's examine the various possible official White House to BRICS pushback options. Now, what could they be? There's really basically a couple. It could threaten to sell all its gold reserves. These things have been discussed. They could threaten to sell all their gold reserves in an attempt to devalue China's BRICS influence. Really? Given that deliberately unaudited US Treasury holdings are to an unknown degree rehypothecated with double ownership claims. So in order to sell its 8,100 tons of gold to effect this pushback, the US Treasury would have to first buy back billions of related underwater Office of the Comptroller bets. which will spike gold even higher. It's too late. The horse has bolted, and the US is left holding less than 1/10 of what the BRICS collectively hold. Less than. So US gold reserves are literally far too small to actually push back. And another reason, and this is another one which we've seen in the past. I think Saylor talked about it. We had various other people in the past pushing back and saying, hey, well, why don't we do this? Especially with the stablecoin mandates being pushed out. So the other idea, and this is what we're going to look at, is that, because it's been trial ballooned more recently, that the US Treasury may try to back its 38 trillion of debt. And that's just official. It's much larger than that. Let's just say they want to back its 38 trillion of debt with freshly generated dollar-backed Treasury stablecoins. Now, however, and essentially what they're doing is that would attempt to devalue this 38 trillion of debt by forcing US Treasury debt on other global central banks. In other words, you've got to use our stablecoin. However, this ignores the fact that the physically gold-backed yuan stablecoin is already one-to-one exchangeable for gold. And those being forced to receive these dollar stablecoins, trade with them, have the option of immediately squaring these debt-backed dollar stablecoins back into gold by way of instant settlement into BRICS, Russia, Chinese-led gold-backed stablecoins, thereby laying off this US dollar debt. I don't see it happening. I don't see it working. Now, this relentless BRICS gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by one of two events. And we've looked at this: either a massive bid only, T+1 margin call, spiking gold thousands of dollars higher, or far more equitably for the US, resolved by a more orderly US Treasury gold price revaluation. And of course, all the liquidity providers, all the smart people are saying, well, of course, they're going to choose that option. So yeah, you can trial balloon all this other stuff, but there's the reality of it. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside of the CME LBNA ring fence, the stealthy gold revaluation process that already commenced directly after the BIS revalued gold has gathered sufficient global momentum to force the US Treasury gold to be competitively revalued. Once it's revalued, the US will want a stronger gold price.
Andrew Maguire's analysis brings into sharp focus the consequences of years of monetary overreach. The United States, burdened with $38 trillion in official debt and countless trillions more in off-balance sheet obligations, stands at the edge of a credibility crisis. Attempting to offset this with a new Treasury-backed stablecoin, one not physically backed by gold, would be self-defeating. In contrast, the BRICS introduction of gold-backed digital settlement mechanisms has already rendered the dollar's dominance less effective. Central banks from Asia to the Middle East are rebalancing away from treasuries and into bullion. As this shift gathers pace, the paper-based pricing mechanisms in New York and London lose their relevance, ceding control to physical exchanges in Shanghai and Singapore, where settlement actually means delivery. The implications for investors are profound. A U.S. gold revaluation, whether deliberate or forced by market realities, would instantly reprice not just gold, but silver and related mining equities. Silver, long suppressed by its association with industrial demand, would likely experience asymmetric gains as monetary confidence erodes. In prior revaluation cycles, silver has outperformed gold by multiples, and given its current supply deficits, the upside potential is immense. Meanwhile, the dollar's revaluation downward would trigger a broad rotation into tangible stores of value. A formal U.S. gold revaluation would signal tacit acceptance that the dollar can no longer serve as the uncontested global reserve currency. It would also mark the beginning of a more multipolar financial order, one in which resource-backed currencies and bilateral trade systems replace the unipolar model of the past century. For China, this would be a validation of its decade-long strategy to accumulate gold quietly while maintaining the illusion of dollar compliance. For investors, it represents both risk and opportunity. Risk in the short-term dislocation that will follow. Opportunity in the long-term revaluation of real money assets. Ultimately, the trajectory of gold and silver is tied not just to inflation or interest rates, but to a systemic recalibration of value itself. As Andrew Maguire highlights, the US can either embrace revaluation voluntarily or face it by force of market pressure. Either way, the outcome favors those positioned in tangible assets rather than paper promises. The global tide is shifting towards sound money, and for those watching closely, the signals are unmistakable. If you found this analysis valuable, please take a moment to like this video, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps us reach more viewers who want to understand the real forces driving the precious metals market. Thank you for watching, and stay tuned for more in-depth coverage of the unfolding battle between gold, the dollar, and the future of global finance.